With the country's banking sector nearing the end of the 2023 financial year, financial institutions are at a critical juncture post-debt restructuring. The impact of macroeconomic conditions has been high on the balance sheets of banks, a situation which has led to some underlying developments on banking sector variables, particularly on bad loans. Citi Business News' Ni Latte has more in the following report.
Recent financial soundness indicators show that the levels of non-performing loans have recorded some significant increase in the banking sector. The year-on-year comparison suggests a nearly 10% rise in the ratio. The industry's non-performing loans increased to an all-time high of 20% in August 2023 from 14.3% in August 2022. The development is attributable to elevated credit risk associated with the lagged effect of macroeconomic crisis in 2022. Simply, the rate at which borrowers fail to make repayment of principals and interest as agreed between them and financial institutions is on the ascendancy. This is not surprising because it is a spillover of the current inflationary pressures, exchange rate volatilities, as well as instability in the real sector of the economy. Some industry players are predicting a further jump in the ratio of non-performing loans if banks do not stay away from funding government projects. This high loan impairment, according to banking consultant Dr. Richmond Etuahene, can only be reversed if banks re-strategize and finance profit-oriented sectors only.
Should all contractors pay their loans, the non-performing will come down. What the banks would have to do, the strategy. Now they should decouple themselves from all government businesses so that you don't finance them. Because when you finance, you're going to have a bad performance. So the banks should strengthen their risk management team, especially the credit risk, to look at sectors they want to go in. If you want to go to services where there is no handled by government, you're going to get paid. But if you go to construction, a higher risk area, you're not going to get paid. And that would affect your non-performing.
However, the Bank of Ghana, which regulates the sector, assures that financial sector development paints a picture that some of these indicators remain broadly stable. It says profitability indicators have improved with a sharp increase in the bank's return on equity and return on assets, with some improved liquidity indicators during the period under review. Banks are essentially making more provisions and increasing capital to cover losses from NPLs, as well as the adverse impact of the government's recent domestic debt restructuring. Despite the gradual recovery, there is a worrying trend of a growing risk aversion among banks. This is evident in the low private sector credit growth. In real terms, there has been a significant reduction in lending to both businesses and individuals. Director of Research at the Bank of Ghana, Dr. Philip Abradu-Otu, at a recent IMF YFM regional course on monetary policy, called for increased private sector credit to sustain the industry's stability.
The weakness also in there is that we see credit to the private sector still remaining at very low levels. And what we would all want in the monetary policy, fiscal policy mix, and banking sector mix is to see banks extend credit to the private sector to prop up economic activity and growth.